When it comes to your retirement planning. I hate to be the bearer of bad news, but you better know the reality as it sits here today. Certainly not going to be Pollyanna here. When you come to Heritage Wealth Planning YouTube channel, you expect the truth. And if you can't handle the truth, this is not the channel for you. So I am going to share an article that will scare you into, if nothing else, it'll scare you out of complacency. If you're complacent about your retirement plan, this hopefully will rock you out of that for sure. Now, just being scared of something and recognizing the risks that are out there doesn't mean it's imminent or even inevitable. You can make adjustments to your retirement plan to fix things if they're going awry. But if you're ignorant of it or you're just complacent thinking that'll just take care of itself, that's ignorance is bliss, and ignorance is not is not a good method for retirement planning. So let's dive right into this, my friends, and welcome to the Heritage Wealth Planning YouTube channel, the place you come to learn to get scared about your retirement plan. Now, look, as always, I want you to retire. I want you to get out of that crappy old job and go do what you enjoy, without question. I'm not one of these naysayers like, oh, you need $10 million. That's silly. But with that said, if we're using retirement projections of the past and extrapolating that going forward, we need another train of thought, because that simply isn't going to work as we go forward. And I'll share with you right now why. There's many articles out there, but this is from a man, Joe Tomlinson. Joe comes to us from Maine. I'll show you a picture of old Joe. And I read every time Joe writes an article, I read him because he's good. He's an actuary and financial planner from Greenville, Maine. All right, so he lives he's no longer in Maine. He's in the UK. I did not know that. I wonder when he moved to the UK. All right. Well, anyway, so he's in the UK now. That's funny. I did not know he moved out that way. But anyway, anytime he writes something, it's on my must read. So you got a guy named Wade Fowle, Michael Kitces, Joe Tomlinson. A couple other guys been drawing a blank on. But anyway, whenever they write something, I read it. I read it the day it comes out. So this came out, yesterday? All right. Retirement risk assessment. History is not a guide. So let me give you the Cliff Notes on the beginning introduction, and then we'll go into his topic I want to talk about that will scare you. So Joe basically uses a Bill Begen study from 1994 in the Journal of Financial Planning to determine withdrawal rates using historical data. And Bengen's the whole point of the 4.4% rule, which is now the iteration today for simplicity is the 4% rule, was he used a 30-year period going back to 1926 with 60% stocks and 40% bonds. The 60% stocks was the S&P 500, the 40% bonds were the intermediate term government bond. And then he rebalanced them every year. And his history said that if you were to live for 30 years, you could take this, what's called a safe withdrawal rate, SWR. You could take 4%. We're just going to say 4% for simplicity off each and every year, adjusted for inflation, and never run out of money. That was the SWR. So what my man Joe says, that's great. We're going to do two things, though, because the 30-year in 1994, when Bengen wrote this, and you can click on the link to read the initial article, which really changed the dynamics of financial planning. You can read that. But anyway, the 4%, the rule back then was you're going to have someone living from 65 years old, for 30 years, so basically he's 95. And the idea of someone living for 30 years in retirement, or a couple living 30 years of retirement, was very, very conservative. So safe withdrawal rate was based on 6% stocks, 40% bonds on a very, very conservative basis of living for 30 years. And now what Joe has done is says, look, 30 years isn't conservative anymore. It's basically average. All right. So now we're going to extrapolate not just a 30-year, but we're going to extrapolate based on longevity rates today. So an average person living who's married, husband, wife, married at 65 today, we're going to extrapolate that on numbers today, which will put more stress on the portfolio because 30 years simply isn't enough. On top of that, let's go down. I'll show you what else I'm going to talk about too. Let's see. I want to show you because he's talking about the stocks versus bonds back then. Real return right here. Real returns. So a real return portfolio of stocks and bonds from 1926 to 2017 was 9.04 for stocks, 2.26 for bonds. A 60-40 portfolio had a real return of 6.33. Real return is subtracting out inflation. So you get nominal return with the inflation. Real returns, you're subtracting out inflation. So remember, in this case, the stocks and bonds are growing at a certain percent. your portfolio, you're pulling it out at a certain percent and you're taking inflation out on both sides of it. So that would give us an apples to apples comparison. All right. So now what Joe does is he says, and this is where I'll start into this piece here because it is kind of concerning. So remember, this is the old one. Real return of stocks, 9.04. Again, after inflation. Real return of bonds, 2.26. And the weighted average of 60-40, 6.33. All right, so let's go dive right into it. Causes for concern. There are few, if any, respected economists, investment managers, or thought leaders of the financial planning community who expect future returns for stocks and bonds to match historical averages. For bonds, returns in the early retirement years will most likely be determined by bond yields at the time of retirement. And it is returns in the early years that have the biggest impact on retirement outcomes. Yields on 10-year Treasury inflated protected securities TIPS are 0.86 as of September 2018. By comparison, the historical years on intermediate government bonds from Ibsen have averaged 2.26. It is virtually impossible to conceive an economic scenario that would drive TIPS yields far enough to negative territory to boost average annual real bond returns to anything approaching historical average. So we're not going to get anywhere. Historical average is this, 2.26. Right now it's 0.86. How are we going to get TIPS to even get anywhere near historical bond averages? It's just not going to happen. So we basically can discount bonds relative to history. Future returns on stocks are not as locked in as bond returns, but dividend growth models projecting future stock returns typically assume 2% dividends growing at a real rate of at most 3%. Dividend growth model, 2%. Every year they increase by 3% a year in terms of your dividend growth rate. So it's hard to come up with an estimate above 5%. Those who pay attention to stock valuation measures, such as the popular CAPE measure developed by Shiller, and I've talked about Robert Shiller a lot. I'm a big fan of him. The CAPE has been overestimating negativity for a long time, but that doesn't mean it's just wrong. It just means it hasn't been right for a number of years. Expressed concern that today's CAPE level is about double the historical average. In the recent CNBC interview, Shiller forecasts a 10-year forward return for the stock market around 2.6. And again, that's a real return. His views have been counterbalanced by Siegel, Jeremy Siegel. I've talked about these guys many times, who has consistently held a much more optimistic view for stocks. But Siegel is even quoted in the summary as saying stocks are overvalued as well. And he is. And even Siegel's summary, we're not looking at a huge rate of return, 7%. I forgot if that's regular, if that's nominal or not. I think that might be real, but either way, he's saying 7%. So we're not getting anywhere near historical. We're not, even if Siegel's right at 7%, even if that's real return, here is a real return historically 9%. Even Siegel's saying 7% real, and that's 25% less than historical norms. And Siegel is not going to say 2.26 on bonds. He's going to say the real return on bonds is about 0.5% as well. All right. So no one is saying that we're going to get near the historical average. No one's saying that. If they are, you got to wonder how. Now, let me sidetrack a little bit. I was listening to Med Faber's podcast. I'm a big fan of Med. And he's saying none of these dividend growth models take into consideration that the companies are actually buying back shares as opposed to paying dividends. I thought that had some validity to that. And I'd actually like to extrapolate on some of that basically. Let's just say dividends are 2% growing at a 3% annual rate. But that doesn't count the fact that when you're buying back shares, you're using the money that could have been geared towards dividends to actually buy back shares, reducing the number of shares are out there and effectively having an increase of usually about 1% growth to 2% year-over-year earnings growth because there's less shares. I thought that was pretty interesting, actually. So let's say even if we're optimistic or pessimistic and saying we're going to get a 5% real return, if Faber is right, Med Faber, and I actually think there's some validity to that, actually, that the real returns are less by 1% simply because as we're buying back shares, you're increasing the earnings growth of the stock market. So basically, stock market growth, it consists of two things and two things only: earnings growth year over year and dividend yields. That's it. There's no other way to extrapolate that. So if earnings growth is historically 5, what we're expecting 5, and dividends rate is 2, you have 7%, you subtract out 3% inflation, and you get a 4% real return. Earnings growth 5%, dividend 2%, 5 plus 2 is 7, subtract out 3% inflation, and then your real return is 4%. Maybe that's what Siegel is saying. It doesn't matter. Anyway, for what we're going to talk about here. What Meb was saying, well, you might be able to extrapolate another 1 or 2% year-over-year earnings growth because instead of that money going towards dividends, going to buy back shares, reducing the number of shares outstanding, which effectively increases the earnings growth per share outstanding. It's tough, I get it. But basically his argument would be, and I'm putting words in his mouth, but this is what I took from his thought process here. If you have a 5% earnings growth year over year, we might be able to say we could get 6, maybe even 7 as we're buying back more shares, reducing the number of shares outstanding, increasing essentially price to earnings ratios. I thought that might have some, or earnings growth. I thought that might have some validity. Either way, we're not getting anywhere the 9% real returns that we've historically had. So it might be 5% real, 7% real. None of those are even anywhere near the 9%. And factor in the bonds, are going to give you 1/2 to 1% real. And I'd even say 1% real might be high. We're not getting anywhere near the bonds historical real returns either. Just not. You're getting both these discounted dramatically. On top of this, so what Joe was saying, on top of these discounted in real returns for bonds and stocks, we have a portfolio that needs to last longer because people are living longer. All right. His views by Siegel. Siegel's quoted stocks are overvalued, but bonds are even more overvalued. So there you go. So Siegel is quoted as saying that stocks may be overvalued, but bonds are even more overvalued. Could not agree with that more. Thus, we could see subpar future returns from both stocks and bonds simultaneously, a much grimmer scenario than compensating returns we've expected historically. And before, my man Joe says, usually when stocks are giving us crappy returns, bonds usually make up some of the difference and vice versa. They kind of offset each other like a seesaw. And we both stocks and bonds are overvalued relative to historical norms. No one would deny that. Real estate is overvalued relative to historical norms. No one's going to deny that. That's just all there's to it. An asset bubble, which is the whole point of the QE, the Ben Bernanke, Helicopter Ben, just dropping money. He wanted to inflate assets. And, frankly, he did it. He did a great job. Assets are highly valued relative to historical norms and relative to the prices that people can afford to pay. All right, so back to Joe. It's impossible to pin an exact number for future stock returns. But in the chart below, I compared measures based on historical performance with Monte Carlo simulations based on arithmetic average returns for stocks of 3% and 5% and 3%. I think that's spot on. And today's tips yield as a forecast bond return. All right, so just real quick, a Monte Carlo is simply we're going to have 10,000 random sequence of random events. So we're going to say it could be 1,000, could be a number, but in this case, we're going to run 10,000 random returns. So each year has its own, just all kinds of stuff going on, 10,000 different times, completely random. It's the safest way to guesstimate what your likelihood of a probability happening. Now, just because a Monte Carlo extrapolates a certain amount, percentage of success or failure, we have what Nassim Taleb Nicholas calls we still have Nassim Nicholas Taleb, your fat tails. All right. So we have a standard deviation, 2/3 of the time, you're going to have one standard deviation. Your performance will be within 66.6% of a median range 2/3 of the time. That's one standard deviation. 2 standard deviations and 95% of the time, and 3 standard deviations, I think it's 99.6 or something like that. What Nassim Nicholas Taleb will say, but on the fat end tails that don't fall into this traditional statistical model, that actually happens a lot more than we expect. And if it were to happen and you're just using the old-fashioned statistical analysis, you're going to be a world of hurt. But this is the best we can do. Monte Carlo will give us a percentage of likely events that happen, and we can make a statistical assumption based on that. Recognize it might never come to fruition, but we got to start someplace. And so Joe starts with real returns of stocks at 5 and 3%, and then tips give us 0.8. So what he says is source of returns, historical real returns for stocks, bonds, weighted average. Forecast 5% real return for stocks, bonds, weighted average. Forecast 3% returns for stocks, bonds, weighted average. So you can see this is half. Forecast of 5% real return is half a historical average. Forecast of a 3% real return is 1/3 of historical averages. And we're living longer. The portfolio needs to survive even that much longer. We see that the forward-looking failure percentages increase dramatically. I also calculated failure ages when funds would be depleted for the 65-year-old couple taking the 4% rule withdrawals. We also, if we use a 5th percentile failure ages as a measure of risk, we say historically we'd fall just short of 30 years, very similar to the worst failure ages in the prior chart. So basically, if 95% of the time we succeed and 5% of the time we fail, we still fall just short of 30 years. very similar to the worst failure ages in the prior years. And so the worst failure ages was here in 1966. If I can, oops, I went too far. If I can show it to you. So this is the worst failure right there. So here we have real stock returns, the worst failure in 1966, real bond returns, a weighted average, and we failed 61% of the time if you would have retired in 1966 based on these numbers, and failure age 93. So we fell from 65 to 93. So we ran out of money in 28 years. And that's the worst case scenario historically. Today, he's saying we still in the 95th percentile. That means we only have if we use a 5% fail, so basically 5% of the time we fail. That's it. 95% of the time we succeed. And even then, we still fall just short of 30 years of basically 28 years, very similar to the worst case scenario in the past. But with lower return forecasts, we don't even make 20 years. Quite a different risk outlook. This difference in risk assessment would apply regardless of the retirement withdrawal strategy being utilized. Fixed withdrawal, where the impact is on the failure age, or withdrawals that vary with underlying investment performance, where the impact is on the level of withdrawals. So he's saying it doesn't matter. At the end of the day, if we get this right here, forecast 3% real return for stocks, 0.8% for bonds, and a real return in weighted average of 2.4, you're going to fall, basically 20 years. It's not going to last 20 years without question. And now if we go again, we go up here to 5, basically less than 1, 3.3, you're still going to fall more often, but big time, than the worst case scenario of the historical range of returns. It's amazing. Stocks have delivered real returns averaging close to 14% per year for the last 9 years. That's real returns. So it may be difficult to imagine a future scenario where returns drop to the 3 to 5% range. However, stocks can only deliver what comes from dividends and dividend growth, plus increases in PE ratios. And with PE ratios, PE being the price to earnings, how much dollars are you going to pay the price for each dollar of earnings? And historically, it's about 15.5. Right now, we're looking at anywhere from 17 to 24, depending on what models they use. No one's going to say it's undervalued. No one's going to say that. So it's historically high PE ratios. So if we can't rely on higher PE ratios to grow, i.e., people paying more and more and more for a dollar of earnings, then the only other ways we get from earnings growth, or if we get it from higher dividends. That's it. And with PEs at elevated levels, the direction is more likely down than up. Could not agree more. Bond return for intermediate and long maturities are largely locked in at current yields. That cannot be debated. I'm going to actually go downstairs later on today and do a live thing on bonds, because I just don't think people get it. For a retirement risk assessment, worst case analysis based on historical returns paints too rosy of a picture. I just want to say it again. For retirement risk assessment, worst case analysis based on historical returns paints too rosy a picture. Instead, Monte Carlo simulations based on realistic average return forecasts with a focus on results at the lower percentiles presents a much more accurate indication of risk. That, my friends, I could not agree more with. All right, so what's the takeaway here? Well, the takeaway is we got to control the one thing we can control: your spending. You're spending. I'm telling you right now, if we are relying on our portfolio to give us that cushion, that is a recipe for disaster. Your spending is one thing you can control. You can't control the portfolio. You can control your spending. You can control when you take Social Security, and you can also control maybe using reverse mortgages and other things to avoid retiring into a down year, and that will kill us for sequence of return risk, which I'll do a thing on that at some point. I just got to get the time. But we got to focus on spending. That is our ability to control what goes out. Now, does this fly in the face of me saying you're going to spend less most likely as you retire? No, it does not. Absolutely does not. Because my thing is always spending first. Spending dictates everything. Cash is always king. Spending dictates everything. But we still got to get an assumed rate of return. And so if we're assuming a rate of return of, say, 3 to 4% real, and we've been expecting a 9% based on historical averages, And we got to make sure we have our ducks in a row with delaying Social Security, getting access to the home equity that you have, reducing unforeseen costs. All this stuff has got to be part of the equation for sure. You just can't rely on your portfolio. You just can't, my friends. And if you are, I hope this is a cold shower that's waking you up. We've got to rely on other things, the things that we can control, because we can't control portfolio. All right. Well, sorry to scare you here, but I'm just telling you, my man, Joe Thomason, read his stuff. This is wonderful. And well, not wonderful, but it's good. So if you like what you see, heritagewealthplanning.com is a blog. Don't forget to go to the blog, subscribe down below. Looks like the sun started to peek out. Love to hear your comments on this for sure. So subscribe, comment, and we'll see you next time on the Heritage Wealth Planning YouTube channel. Thanks now.